Here we are, guys. Episode 6. Where we left off last week was talking about my boy Jeremy and his letter. Great letter. Please go read it. Links in the bio. And just a quick recap, it was really just talking about the bubble that we're in is not just a bubble, it's a super bubble because there are multiple asset classes that are, due for a correction. And in that correction, they'll fall back to where they were pre-bubble levels, maybe even more. And kind of where does that leave us, right? And how do we think about this as individual investors? So, and really how I'm thinking about it. But again, quickly, oh wow, excuse me. Hope everyone's being safe. Shout out to new listeners, old listeners, wherever you are. If you're listening to this in some other country other than the U.S., definitely please give me a shout out. Love to give some kudos to my listeners. I see I have like listeners in like Estonia and Australia, so that's like super cool. I don't know who's listening to me in Australia, but hey, thank you. But no, in all seriousness, please go subscribe and on YouTube so you get these video alerts, and then also wherever you do get your podcast, make sure to follow so you get those new episode uploads right away. And then please click on the link in the bio how to subscribe to the emails so you guys get everything, how to get into investmentbanking.com. Just click on that link and it'll take you, put in your email, you get all these updates automatically. And definitely like and subscribe, definitely helps a lot. Just a quick, I was always against, I was like, you know what, when I get into YouTube and start doing this, I'm not going to say it. I felt like it was kind of like cheesy or whatever, but listen, guys, that stuff actually does like really help getting this stuff out there. So I'd really appreciate it. But anyway, I'm going to jump into the back half of his memo because it is really, really deeper. This is a part where I was like, he was not attacking. I think he's just calling people out, so how did this happen? And will the Fed ever learn? And I'm sorry, Jeremy, they will not learn. But here's what he said, right? Is that, in the past 25 years, we've had three, relatively large asset bubbles, right? And he literally, I think this sentence says it all, right? I believe this is far from being a run of bad luck. Rather, this is a direct outcome of post-Volcker regime of dovish Fed bosses. It's a good time to ask why on earth the Fed would not only have allowed these events, but should have actually encouraged and facilitated them, right? And what's important to understand is that a lot of people who are at the Fed chairs, regional chairman, whatever, a lot of folks are academics, right? And they truly believe in market efficiency. And this is where Jeremy's like, hey, he was like, look, Greenspan didn't really care, right? And he started a lot of this, deregulation kind of trickle started, let's say, mid-90s. And he's making the case that, hey, shouldn't Bernanke have learned from that, right? And from the experience of the pain of these bubbles bursting. But, they believe so much so in market efficiency that these bubbles can never occur. And what's even more dangerous to that is that these are views that they are committed to, right? And I didn't know this. I actually had to go find this clip that Bernanke actually, these were his words, right? Is back in 2008 when we could have had a potential 3 Sigma event, right? Even though equities weren't that overvalued at that time, Ben Bernanke did say this, and I'm a huge Ben Bernanke fan because he did what he had to do, I think. But Jeremy, he gets into that point is like, why did you have to do what you have to do, which was lobby Congress to bail us out? It's because you got us in that position in the first place, right? And we'll get to that later. It's kind of like he gives a great analogy. I'll just get to it right now real quickly. He was like, where's the great analogy he gave? Yeah. He said, yes, Bernanke and Paulson did a perfectly fine job lobbying Congress to help, but overall, it was as if the Fed, at the wheel of a titanically sized economy, had imprudently raced the economy through dangerous waters, ignoring the risks of icebergs so profoundly that the captain deserved a court-martial, but instead, after the boat sank, was rewarded for doing a serviceable job of helping women and children into lifeboats. And then Greenspan even fought to help the boat speed up because they didn't want to regulate subprime instruments, which they didn't, and that's why we are where we are. So, we could speak on the politics of that later, but that is a great analogy, is that while we came out of the crisis, everyone's like, hey, Bernanke did the right thing. That stimulus was needed. Why were we in a position where the stimulus was needed in the first place, right? And it's easy to say that in hindsight, but it's also not. It's because they should have been aware of the perils of that level of deregulation. And I think that's the argument he's making, is that, hey, I'm not saying all regulation is good. You do need some things to be deregulated so things move with less friction. But where's that oversight? And how do you have objective oversight? And this is age old, right? How do you have objective oversight into things when they're deregulated, right? Because then if you have oversight, isn't that regulation? But anyway, going back to Bernanke saying that, hey, the U.S. housing market merely reflects a strong U.S. economy, and the U.S. housing market has never declined. And just based on statistics, his thinking is like, hey, house prices can't be in a bubble because house prices are kind of insulated and they're protected and they're so diverse that, something could be booming on one coast and steady in another and falling in another, right? So that's his thinking. And I'd like to think there's more beef behind that. I'm sure there was. But Bernanke did say that, which I think is a little concerning, that the Fed chair would say something with such, I don't say crass, but with something with such a laissez-faire attitude. So if I find that clip, I'll share that to you. But the biggest thing to kind of take away from, like, okay, how did this happen? And as an investor, when you're thinking about, again, we can't control what the Fed does, but we can control what we do based on what we know what other people are doing, right? So where is that? Right here. Okay. So look, that bubble in 2008, it came and went, right? Housing prices dropped. They dropped to what they were before bubble levels, and then they dropped even further. And then that led to what I'd say is obviously a very much correlated damage in the stock market, which led to real wealth loss, right? It was generational wealth. A lot of people were retiring, like that shit was gone, right? You may have had to wait like 3 years, right? Because there's nothing there. There was the depression, and then you needed a bailout. So people kind of understood that. But this is what I think what makes Jeremy a great investor. But the problem with this, and this is what I say to everyone, is like, look, we can look back and we can do all the analysis we want. We can go back and we can try to understand things and why people acted the way they did, and is it right, is it wrong, evaluation perspective. But the reality is, and what I'd love to get Jeremy's, if I said this to his face, is like, does it really matter what you think or what I think? Right? Because valuations are something is only worth what people are willing to pay for it, right? So what they're trying to do is trying to get out in front of that. And I would surmise that he might say, like, Sajin, you're right. Things are only worth what people are willing to pay. And, the value, what you take GameStop, people were willing to pay that much for it. And that's why that price went up that much, right? Because retail investors went in and did that, right? I can make the argument that he's trying to get out in front of this and saying, like, hey, we're doing the research to say, hey, we understand that, but we know what the consequences of that will be. And the consequences of that will be X, Y, and Z. And because of that happening, we know that there's going to be an imbalance in these asset classes. An imbalance being that, hey, these value stocks are going to be seen as something to be more valuable, something that are going to be seen by others to be, hey, this is going to be worth more than what a growth stock is. So we're going to go out and get ahead of this stuff with the research we're doing, and then ultimately place our bets and our money and our investor capital into these value stocks and short some of these growth stocks, because we know at a certain point, investors are going to start devaluing them and not appreciating them and giving them the valuation that they had before. I suspect that's what his answer would be to me, which is a great answer. But as it pertains to the layman and retail investor, you don't have that research. You don't have that information to go and surmise that shit out and run a long short strategy if you're working a job and you're doing this, right? That's why it's like, hey, diversify your shit. It sounds boring, but that's what it is. And, you can overweight certain things into growth and value depending on where you stand. But again, the point being is, I truly believe as an individual investor, there's only so much you can do unless you do it full time. That would allow you to get out in front of things, like it allows people like Jeremy to then give them the foresight to be like, hey, here's how I can hedge the portfolio today and make money both from growth going up and then down, and then that dislocation in value being lower, being valued lower compared to growth, and then that increase that we'll see. So that's kind of my thoughts on that. And I think the takeaway for anyone who's listening to that is you have to understand that too when you put your money into the market as well, is that something will only be worth what it is. But given the complexity of all these factors now that are hitting from all angles, what's going to be the perceived worth of this asset down the line? And this is what kind of like goes in the face of doing like traditional security analysis and ripping things apart, because, and I don't want to get too philosophical. I want to stay on point. But then the problem becomes is that you can look at a company and be like, hey, great cash flow. It's trading at this multiple. No reason it can't be in a higher multiple range and a premium because it's growth or whatever, or it's stable. Because external factors will impact the point of view of other investors who then impact your actual investment. And that's like the harsh reality of it, right? Is that you can only stress so much about how other people are going to perceive it versus saying like, hey, good company, good balance sheet, good moat, let's rock with it, right? So, moving on from that, this is actually no. The one thing right here is I just want to put this right here is is that this was great. It was like, clearly we know the dangers of an equity bubble. We've seen that from 2000 to 2002. What happens when there's an equity bubble? And what are the greater dangers of a housing bubble, as we saw from 06 and 010? Because that housing bubble, sure, that equity bubble might damage perceived wealth. Housing bubble is real wealth. It's a real asset that you live in. But that mortgage you carry, right, at that interest rate, that's a very real thing too, right? And so what he's making the point is that, hey, the Fed has seen two things in America. Equity bubble 2002, housing bubble 06 to 08 or 2010. And what does the Fed learn from that? And what I love here is like absolutely nothing, or so it appear. In fact, the only lesson that the economic establishment appears to have learned is that we didn't address it with enough stimulus. So we should that we should actually have taken precautions to avoid the crisis in the first place seems to be a lesson not learned, not even taught. And so you settle for more lifeboats rather than avoiding icebergs. And I think that's really something to think about as an investor, is how do you bring that mindset? And the reality is, like, we can't do it. Like, you can't do anything about the Fed acting, right? But how do you as an individual investor be more mindful of these macro factors that will impact things both in the short term and the long term, and have guardrails set up of like, hey, when am I going to sell? What percentage of my portfolio am I going to sell at when? What gains am I going to capture? How am I going to secure and keep those gains safe? Those are the things that I think you, the individual investor, can learn from, guys like Jeremy, particularly this article, in particular. Excuse me. So, yeah, guys, that's the answer, right? Just more stimulus, right? Make that money printer, just keep it going. No, but look, I don't blame him. I think he's being a little overly critical, because it is hard to not be in their shoes and then just kind of pretend like we know what was really going on and how you would have acted in that situation. It's hard to say that. But guys, as I kind of wrap up on the back half of his article, what's really concerning and scary, not really scary, I mean, I think most people who have white collar jobs, you went to the top 30 university, in theory you should be fine unless you're just kind of blowing your money every weekend. Excuse me. There's a pun in there for people who got that, but if you did, please DM me. I'll send you a gift card. And the scary thing is right here where you're talking about bubbles, growth, and inequality. And is this, right, that the most important long-term negative of these bubbles is that there's sustained pressure increasing inequality. And this is so true, right? Because poor people, and I say poor people because I don't consider, like, poor, when people say, when he says like the poorer quarter of the public, let's be clear, like, people who work 9 to 5s are fall into that poorer quarter, right? Like, you're not capturing the upside of this bubble, right? That top 1%, let's say you're making more than 500K, you're going to see that upside of that bubble materially, right? And what's going to happen from that is that you're not capturing any of that upside of the bubble, but you're going to definitely feel all of the downside, right? And what was the best analogy he made right here is that this inequality is on the margin as you get richer, and the rich getting richer, right? That 1%, they're not going to, like, the incremental gains that they see, they're not going to necessarily be spending that to the point where it's material to them, versus that lesser quarter. We're going to spend that, right? And that's real money that we're going to know that we're spending. But then what happens when we don't get to participate in the upside, and then we get hit with that downside, right? And that ties back to what he was saying earlier about the real impact on income, right? And then price increases. And then there's being a pressure. Hey, it's going to stress the income we have because it's not growing, right? And the purchasing power has been reduced. So here we are again, right? As he says, is that, we have world record stimulus. We have all these valuations that have now pushed, these asset classes kind of way up. But this is the scariest part, right? Is that as these bubbles crash and come down, even if these valuations return to 2/3 of what they were, to like a historical level. So I guess what he's using, I want to see let's see what this data set is, because I don't know if he's referring. Always read the footnote, guys. All right, footnote 5. Conveniently not here. Oh, okay. The back of the envelope calculation goes like this. Currently, the U.S. non-financial corporate sector is worth $48 trillion. If cyclical adjusted PEs fall from their current level of nearly 40 to 25, which would still be among the highest valuations ever recorded, this would be a 37% loss of value over $17 trillion. U.S. households own real estate worth $41 trillion. Yeah, I was right. The price to income ratio about 5.5. If it returns to 4, which is well above any levels prior to mid-2000, this would be a 27% loss of value over 11 trillion. U.S. Treasury corporate debt that came to about 24 trillion, 11 trillion, 15 trillion. Duration of the loans of the corporate debt, rates rise of merely 2%. Oh shit. Yeah. Okay, so if we scroll back up here, oh my god. If we scroll right here. So what he's saying is right now he's saying, hey, the bubble, the party stop, right, for growth stocks, whatever, it's going to keep going down. It's going to climb up to blue chips, and we're going to see a crash in stocks. Housing market, that's going to come down. Commodities, whatever, all these things are going to come down. What he's saying is that from that base level, even if things get back to 2/3 of what they were, the wealth lost is still going to be on the order of magnitude of $35 trillion. And how we got to that was back of the envelope math. What he's saying is like total wealth lost in corporations. What that means is like he's just looking at like, hey, what are corporate stocks valued right now to PE ratio, and what is that implied market cap? Now, let's say PEs get adjusted downward. What's the implied market cap? And then he's taking the delta between market cap at like that norm or 2/3 of that norm and market cap what it will be when it falls down. And he's taking that delta saying, hey, that's like the value that we're losing. And that's one part of it. Then the other part of it is the housing math, which he's saying right now houses are 5.5x multiples of income. Let's say it falls down to 4x. That gap of what houses are at 5.5 of income to 4, that delta, that makes up the other part of the 35 trillion. And then what was his last thing that he said? The other part of U.S. Treasury. He's just saying that, hey, what duration is corporate debt being raised at, and what happens when rates get raised? And he's saying, hey, that income, that's also another part of that 35 trillion dollar, perceived loss. So yeah, Jeremy has a lot of great points, but again, I think that all this points to is like, it still points to there being opportunity, right? I think that I think what this just makes everyone coming out of this is a smarter investor, knowing that there are other factors that will go into driving asset prices, understanding that, hey, you need to be aware of how external factors will impact assets that you think were insular to being impacted. And I think it's going to be a nice wake-up call for a lot of people. And the last thing that I'll touch on, because we all know that I love to talk and I can do that, and I'll kind of give my closing thoughts. But before I get to the closing thoughts, something I want to actually see, this is, before I get to the closing, this is what I wanted to touch on, right? Is that the example of like things are worth what the value makes it, right? Which is, he talks a bit about GameStop, AMC, Dogecoin, Hertz, and Avis. And this is where he touches on something that I like to, I really am going to start using this, is the narrowing market, the narrowing phase of the bubble. And essentially, I mean, I haven't done the math on this, so I mean, I'm sure I'll look in his footnotes and see how he got here. But what he's essentially saying is that in this, oh my God, this is so painful to read out loud, very painful, is that, you know, in the final narrowing phase of this bubble, most of these events, which are like, you know, these great bull runs and things like Dogecoin going up and meme stocks and, you know, even growth stocks hitting a peak in like summer 2021. He's like, there's a numbness to that euphoria. And he said more than 1/3 of NASDAQ stocks are now down more than 50% from their highs, which is painful. And again, people might say like, Sajin, he's saying all this in hindsight, but he's not. You know, they're saying that, hey, we knew this was going to happen because of the trends we've been following. We got out ahead of it by being long certain growth value stocks and shorting growth stocks. And I think they said that their portfolio beat growth stocks by 15%, I believe, which is pretty impressive, because I don't know what their absolute return is, but they're saying, you know, whatever their returns were, in addition to that, they beat whatever growth stocks came back out by an additional 15%, which doesn't make sense to me, because I know whatever growth index you look at, I know growth stocks are down broadly, let's say 21% in 2021. So if you're saying you beat them by 15%, you're still down 5%. So I'm going to go down to his footnotes because I don't question some of that math. But the last two things that I'll talk about, and we'll call it a day, is this analogy right here. He calls it the death of the vampire. He's like, in the meantime, we are in what I think of as the vampire phase. And I've literally never heard of that, but maybe I'm going to definitely use this now. We are in the vampire phase of the bull market, where you throw everything you have at it. You stab it with COVID, you shoot it with the end of quantitative easing, the promise of higher rates, you poison it with unexpected inflation, which has always killed PE ratios, but quite uniquely not this time yet. And still the creature flies. Just as it staggered through the second half of 2007 as its mortgage and other financial wounds increased one by one, until, just as you'd begin thinking that this thing is completely immortal, it finally, and perhaps a little anticlimactically, kneels over and dies. The sooner, the better for everyone. I think that's great. We're in the vampire phase of the bull run. And what I take away from that is, look, I'm still going to double down on growth, because I believe that the world is changing, and there is an opportunity, depending on your time horizon, to build up very nice, strong positions in these growth stocks. And, you know, I still believe in that. I do believe that there is an opportunity to capture serious gains in value stocks. And that's where I think hedging comes into play, where you can capture gains. And maybe when you think the correction is happening, you can then pivot out of some of your value positions into some more growth names, right? So, yeah, I mean, that's my thought, and that's what I will be doing. But I'll end it with this. I know I keep saying that, but this is really good. He had a nice thing at the bottom where and people are following along. He kind of explains inflation and PE ratio, and this chart is really, I don't want to say enlightening, but interesting. Is that the bubble we're seeing today, and this is crazy because I mean I've never looked at this and I never really thought about it, is that right now the bubble that we're facing is ignoring inflation 100%. And what does that mean? So folks who are watching, you can see it, but this chart is just showing, excuse me, I'm assuming this is their PE model where they're showing price to earnings ratio of what they're predicting. Maybe I don't know what index they're tracking, but whatever, greater corporate PE ratios, right? And what they're trying to explain here is, hey, what is the impact of inflation and what is the impact of margin, profit having on PE? Because, inflation, it's going to damage PE. Profits going to obviously inflate price to earnings ratio. But the research shows is that since 1925, inflation surges had always hurt multiples badly until now. And that's why I said inflation is 100% ignored now. I mean, if you look at this, this is insane. This is literally showing, hey, what is the volatility of, one, they're showing that correlation, but one, they're saying, hey, what we think PE multiples should be. So if you look at this, this is clearly 2000, 2002. What should price to earnings ratio be? But where is it actually? And then you fast forward to 2016, and this right here is 100% is 2019, 2020, 2021. But look at where PE actually is. So that to me tells me that there's going to be some sort of crash in value stocks too, right? Because if you're telling me that PE ratios aren't being impacted by the cost of inflation or just ignoring it, when do people stop ignoring it? And I don't know. He didn't talk about that at all in this article. That kind of begs me to question. I know you have a long short strategy, but when does that party stop of, hey, we're not going to ignore the cost of inflation and PE multiples will be representative of that. So, to recap, he has a nice thing here, and I think everyone should go and read this, is Rules of the Bubble Reviewed. I should clip this out and just Rules of the Bubble Reviewed by Jeremy, the GOAT, right? All 2 sigma equity bubbles in developed equity markets have burst all the way back to the trend, and the U.S. has reached 2 sigma level in the summer of 2020. So he's saying that, hey, we had that 2 sigma bubble in 2020, but some of them went on to be 3 sigma or more, producing longer and deeper pain, and we have reached a 3 sigma bubble in late 2021, which for me, I think was July 21, August 21, truly signified, hey, we have 3 bubbles going on at the same time. And this is the hardest part, right? Timing is uncertain. And when you get to 3 sigma super bubbles, such as what we have now, housing, equities, and commodities, there are a few examples that we can lean on, but they all have the same characteristics before they go, gangbusters and break. One, a speculative investor frenzy that generated stories for distant decades, which we have had for well over a year. So you think back to 2000, 2002, many stories. And if you go back to now, 2020, 2021, we've also had the same stories, right? Whether it's meme stocks, growth stocks, cryptos, NFTs, whatever. And then a blow-off phase where stock gains accelerate, as we had in 2020, where the blow-off phase is where he's saying is that, hey, the blow-off phase occurs when stock price growth accelerates at 2 or 3x the average of the preceding bull markets. If you look at the bull market from 18 to 19, and then you look at bull market from March 2020 to onward to, let's say, summer 2020, that rate of growth was 2 to 3x of what we'd seen in the preceding bull market run. It's the second thing. And the third thing is right here, that narrowing phase, right? Unique to these few super bubbles, where a decreasing number of very large blue chips go up as riskier and more speculative stocks underperform or even decline, as they did in 1929 and 2000, and as they have done so since February 2021. And he's like, if A, B, and C are accounted for, light the blue touch paper and retire to a safe distance. But point C is really, really important, because to me now, are you implying that we have to be worried that these blue chip stocks are also going to be facing these same issues as these growth stocks? And what problems does that constitute? I don't know. And I think that's why the only thing you can do, and what I'm going to do, is, again, continue to hedge 25% into, some individual names, 25% into value index, 25% into growth, and then 25% into random assets, right? Whatever I want to speculate on, whether it's cryptos, NFTs, whatever, right? That is what I'm doing, just to get exposure, and I don't feel confident enough to place large bets on any one thing in particular. So look, guys, fantastic episode. Thank you so much for coming along. If anyone has questions, wants to talk more, anything else, please comment, subscribe, hit me up, let me know what's good, and I will see you guys for episode 7. All right, take care, be safe, and stay classy, guys. I'll talk to you guys later. Bye.